It's October 19th, 1987. You wake up that morning, check the news, and everything seems normal. The economy is humming along. Stocks have been climbing for years. Wall Street is riding high. Then the markets open. Within hours, the Dow Jones plummets 508 points. 22.6% of its value vanishes in a single day. $500 billion erased. Panic spreads like wildfire across trading floors worldwide. People are losing everything. Retirement accounts evaporate. Dreams crumble. But while millions watch their savings disappear, a young hedge fund manager named Paul Tudor Jones is celebrating. That day, while the world burns, he makes roughly $100 million. This isn't luck. This is the game. And if you think Black Monday was unique, think again. Because the same pattern has played out in every major financial crisis since. The same names, the same strategies, the same massive fortunes built on everyone else's terror. From 1987 to the dot-com crash to the housing meltdown to the pandemic panic, a small group of billionaires and hedge fund managers have turned every market collapse into their personal gold mine. They don't just survive the crashes, they engineer their profits from them. Black Monday, October 19th, 1987. It's worth understanding what actually happened that day because it set the template for everything that followed. The crash wasn't random, it was the result of a perfect storm. Computerized trading programs that sold automatically when prices fell. Portfolio insurance strategies that forced more selling into a falling market. Rising interest rates that spooked investors. A dollar in decline. Trade deficits ballooning. But here's what matters. Most investors were caught completely off guard. They believed the bull market would last forever. They'd piled into stocks using borrowed money. When the crash hit, they were wiped out. But Paul Tudor Jones saw it coming. He'd spent months studying the market. He noticed something nobody else wanted to acknowledge. The patterns of 1987 looked eerily similar to the patterns before the 1929 crash. He didn't just think about it. He acted. Jones built massive short positions. He bet billions that the market would collapse. His team at Tudor Investment Corporation positioned themselves to profit when everyone else panicked. They used technical analysis. They studied historical data on the S&P. They recognized that valuations had become completely detached from reality. The Dow had gained 44% in just 7 months. It was unsustainable. When Black Monday hit, Jones's fund returned 125.9% after fees that year. That single trade earned him an estimated $100 million personally. At 33 years old. Think about that for a moment. While teachers and firefighters and factory workers watched, their pensions crumble. A guy who'd been trading cotton futures a few years earlier pocketed $100 million in a day. And Jones wasn't alone. There were others, smaller players. But what's fascinating is how Jones responded afterward. He bought up almost every copy of a PBS documentary about his prediction. The film was called Trader. He didn't want anyone seeing it. Some speculate he feared it gave away his methods. Others think he just didn't want the publicity. Either way, the message was clear. Keep the secrets in the family. Now, here's where it gets interesting. The Federal Reserve's response to Black Monday created a precedent that would define every crisis going forward. Fed Chairman Alan Greenspan immediately pumped liquidity into the system. The central bank essentially promised to prevent a total meltdown. Markets recovered fast. Within 2 years, the Dow surpassed its pre-crash highs. This taught the world a lesson. The Fed will always step in. The government will always provide a cushion. And if you're positioned correctly, if you understand the game, you can profit massively from the panic before the rescue arrives. This became known as the Greenspan put, the implicit guarantee that the Fed would support markets. It created what economists call moral hazard, the incentive to take bigger and bigger risks because you know someone will bail you out. For billionaire investors, this was a revelation. It meant that crashes weren't threats, they were opportunities. Buying opportunities, as long as you had the capital to weather the storm and the nerve to buy when everyone else was selling. Fast forward to 1992. Britain is part of something called the European exchange rate mechanism. It's supposed to stabilize currencies. The British pound is pegged at a fixed rate to the German mark, 2.95 marks per pound. But there's a problem. Britain's inflation is 3 times higher than Germany's. The British economy is struggling. The pound is overvalued. Everyone in the financial world can see this isn't sustainable. Except the British government insists it is. They defend the peg with everything they have. Enter George Soros. He'd already made his fortune. But he saw an opportunity that was almost too obvious. The pound was trading at an artificial price. Basic economics said it had to fall. So Soros did something audacious. He borrowed billions to massively short the pound. He bet that the British government would be forced to devalue. On September 16, 1992, the UK spent billions trying to prop up the currency. They raised interest rates twice in one day, from 10% to 12% to 15%. They bought pounds desperately, but the tide was too strong. By evening, Britain withdrew from the exchange rate mechanism. The pound collapsed. George Soros made over £1 billion in profit in a single day. They called it Black Wednesday. The man who broke the Bank of Shilvath, England. Soros didn't cause the crisis. The unsustainable currency peg did. But he profited enormously by betting against a system that was doomed to fail. And here's the pattern emerging. These billionaires don't create the bubbles. They don't cause the structural problems. They just recognize them earlier than everyone else. Then they position themselves to win when reality catches up. The late 1990s brought the dot-com bubble. Everyone remembers this one. Internet stocks soaring to insane valuations. Companies with no revenue, no profits, no viable business models trading at billions of dollars. Pets.com, Webvan, Cosmo. The madness seemed endless. The Nasdaq rose 582% from January 1995 to March 2000. Price-to-earnings ratios hit 200, far beyond anything rational. Ordinary people poured their savings into tech stocks. Day traders quit their jobs to trade full-time. Everyone believed the old rules didn't apply anymore. This was the new economy. The internet changed everything. Then it all came apart. Starting in March 2000, the Nasdaq fell 75% over the next 2.5 years. Trillions in paper wealth evaporated. Hundreds of companies went bankrupt. Millions of people lost their life savings. But who made money? The story here is murkier than other crashes. Very few investors successfully shorted the dot-com bubble. Why? Because short selling requires precise timing. These overvalued stocks kept climbing higher and higher. Shorting them too early meant getting crushed by the continued rise. Many who tried went broke before being proven right. But some did win. Mark Cuban, who'd sold his company Broadcast.com to Yahoo for $5.7 billion in stock, had the presence of mind to hedge. He shorted Yahoo stock to protect his windfall. When the crash came, his hedge saved him. He locked in his billions, while others watched their paper fortunes vanish. Michael Burry, who would later become famous for shorting the housing market, was already making moves. In February 2000, he was reported as being short on Amazon. The stock would lose 80% of its value over the next year. But the big lesson of the dot-com crash was different. It showed that even massive, obvious bubbles are hard to profit from if you're too early. The market can stay irrational longer than you can stay solvent. The crash also revealed something else. The Federal Reserve would respond to every crisis the same way. Alan Greenspan slashed interest rates aggressively, from 6.5% in May 2000 to 1% by June 2003. The cheap money policy designed to prevent recession created new problems. It made borrowing incredibly cheap. It pushed investors into riskier assets searching for returns, and it helped inflate the next great bubble. Housing. By 2005, anyone paying attention could see the housing market was insane. Home prices had doubled in many markets. Lending standards had collapsed. Banks were giving mortgages to people with no income verification, no down payment, terrible credit. They called them ninja loans. No income, no job or assets. Wall Street was packaging these garbage mortgages into securities and selling them worldwide. Rating agencies stamped them AAA. The whole system was built on fraud, or at least on willful blindness. Most people believed housing prices would rise forever. They'd never fallen nationwide in living memory. Why would they start now? But a handful of investors saw the disaster coming, and they positioned themselves to profit spectacularly. Michael Burry was one, a medical doctor turned hedge fund manager who spent months reading individual mortgage loan documents. He discovered something terrifying. These subprime mortgages, especially the adjustable rate ones, were designed to fail. They offered low teaser rates for 2 years, then reset to rates borrowers couldn't possibly afford. Burry calculated that when these resets hit, massive defaults would follow. The mortgage-backed securities built on these loans would collapse. So Burry convinced big banks to create a new financial instrument: credit default swaps on mortgage bonds, essentially insurance policies that paid out when the mortgages failed. The banks thought he was crazy. They happily sold him these swaps, collecting his premium payments while believing they'd never have to pay out. Burry faced enormous pressure. His investors revolted. They couldn't understand why he was paying millions in premiums betting on a housing crash that seemed never to arrive. Some demanded their money back. Burry held firm. Then 2007 arrived. Mortgage defaults started spiking. By 2008, the entire financial system was collapsing. Bear Stearns failed. Lehman Brothers went bankrupt. AIG needed a government bailout. The global economy teetered on the edge of depression, and Michael Burry's credit default swaps paid off massively. His fund Scion Capital made over $700 million for investors. Burry personally netted $100 million. He was vindicated. But he was far from the biggest winner. John Paulson made history. His hedge fund Paulson & Company generated over $20 billion in profit from shorting the housing market. $20 billion. Paulson personally took home between $4 and $6 billion. In a single year. The greatest trade ever, some called it. How did he do it better than Burry? Scale and timing. Paulson raised enormous amounts of capital specifically to bet against subprime mortgages. He bought credit default swaps on the riskiest mortgage bonds, the BBB-rated tranches that were cheap to insure but most likely to fail. He shorted the stocks of companies most exposed to subprime. He went after Fannie Mae, Freddie Mac, Lehman Brothers, Bear Stearns, Washington Mutual. Paulson's bet was simple. The housing market would crash, subprime borrowers would default, the mortgage-backed securities would collapse, the financial institutions holding them would fail. And he positioned himself to profit at every level of the disaster. When the crash came, it was even worse than he'd imagined. His fund made money beyond anyone's wildest dreams. While millions of Americans lost their homes, their jobs, their futures, John Paulson became one of the richest men on earth. But he wasn't alone. David Tepper, running Appaloosa Management, took a different approach. Instead of betting against the housing market early, Tepper waited for the crash. Then he bought when everyone else was selling. In early 2009, with the financial system in ruins and banks failing, Tepper started accumulating distressed bank stocks and bonds. He bought Bank of America common stock at $3 a share. He bought Citigroup debt. He bought AIG bonds for 5 cents on the dollar. Everyone thought he was insane. These companies might go bankrupt. The government might let them fail. But Tepper bet on something else: government intervention. He believed the federal government would never allow the entire banking system to collapse. The political consequences would be too severe. So he bought massively, using the panic as cover to accumulate positions at fire sale prices. He was right. The government bailed out the banks. The Federal Reserve pumped trillions into the system. Stock prices recovered. Tepper's fund made $7 billion in 2009. He personally took home $4 billion. In 1 year. By betting that the government would rescue Wall Street, this is crucial to understand. Tepper didn't bet on the bank's fundamentals. He bet on the bailout. He understood that the system was too corrupt, too interconnected, too politically powerful to be allowed to fail. Privatize the profits, socialize the losses. That's how it works. And if you understand that, if you position yourself correctly, you can make a fortune. Ray Dalio's Bridgewater Associates took yet another approach. Dalio had studied economic cycles for decades. He understood debt dynamics. He saw the housing bubble forming years in advance. Bridgewater didn't make huge concentrated bets like Paulson or Burry. Instead, they built a diversified portfolio designed to profit in a crisis. They owned gold. They owned treasury bonds. They had positions in currencies. Their Pure Alpha fund gained 9.4% in 2008, while the S&P 500 lost 37%. Not as flashy as Paulson's billions, but Bridgewater's clients were protected, while most investors were slaughtered. The 2008 crisis revealed the playbook clearly. See the bubble forming, position yourself to profit from the collapse, or wait for the crash and bet on the government bailout. Either way, if you have capital and nerve, you win. The pattern was set, and it would die. Repeat. Fast forward to March 2020. The COVID-19 pandemic hits. Global economies shut down. Markets crash faster than any time in history. The S&P 500 fell 34% in just over a month. Faster than 1987. Faster than 2008. It was the quickest bear market in recorded history. Unemployment exploded. Businesses closed. Panic was everywhere. But the billionaire class was ready. Bill Ackman, running Pershing Square Capital, had been watching news out of China. He understood pandemics could spread globally. In early March, he quietly bought $27 million worth of credit default swaps, bets that would pay off if corporate bonds collapsed. A week later, he went on CNBC. In an emotional, almost tearful appearance, he warned that hell is coming. He said the government needed to shut down the entire country for 30 days. He predicted Hilton would go to zero. The market was going much lower. His comments terrified viewers. Some accused him of fear-mongering for profit. Because here's the thing. By the time he went on television, Ackman had already made his bets. He wasn't warning people to help them. He was talking his book, creating more panic to drive his positions higher. 4 days after his television appearance, Ackman sold his credit default swaps. He turned his $27 million investment into $2.6 billion, a 9,500% return in less than a month. Then he used those proceeds to buy beaten-down stocks. He bought more Hilton, the same company he'd said was going to zero. He bought Lowe's, he bought Starbucks. When the government and Federal Reserve stepped in with trillions in stimulus, those stocks soared. Ackman made even more money on the recovery. Was this illegal? No. Was it ethical? That's a different question. Ackman defended himself, said he was genuinely worried, that he sold his hedges once he saw the government taking action, that his emotional television appearance was sincere. Maybe, but the optics were terrible. Billionaire makes billions betting on disaster, goes on television amplifying fear, then profits twice, once on the way down and again on the way up. Meanwhile, regular people were losing jobs, losing businesses, dying from a virus. Ackman wasn't alone. Mark Spitznagel runs a hedge fund called Universa Investments. They specialize in tail risk hedging. Essentially, they buy cheap insurance against market crashes. Their strategy loses money most of the time. The premiums eat away at returns. But when disasters hit, they win spectacularly. In the first quarter of 2020, Universa gained 4,144% in 3 months. They turned a relatively small position into massive profits by betting on extreme events that most investors ignore. The COVID crash also revealed another winner. Regular retail investors, the Robin Hood generation. When markets crashed in March, millions of young people opened brokerage accounts and started buying. They had stimulus checks. They were stuck at home. They bought stocks everyone else was dumping. They bought airlines, cruise lines, restaurants. They bought on the dip when institutional investors were selling in panic. And they made fortunes. For once, the little guy won. Because they had the advantage of not needing to sell. They had time. They could hold through volatility. And when the recovery came, they profited. But the biggest winners, as always, were the billionaires who understood the system. They knew the Federal Reserve would respond with unlimited money printing. They knew the government would hand out trillions in support. They positioned themselves accordingly, and they made fortunes. Again. Now, let's zoom out. What's the pattern here? Every financial crisis follows the same script. First, a bubble forms. Asset prices rise far beyond any rational valuation. This happens because of cheap credit, speculation, new narratives about why things are different this time. The bubble grows. Warnings are ignored. Anyone questioning it is called a pessimist or an idiot. Then, something breaks. A catalyst triggers the collapse. Black Monday in 1987 was partly triggered by computerized trading and rising interest rates. The dot-com bubble burst when people finally realized companies with no profits weren't worth billions. The housing crash came when adjustable rate mortgages reset and defaults spiked. COVID was an external shock, a pandemic that shut down the world. When the crash hits, most investors panic. They sell. They try to cut losses. They need liquidity. This selling creates more downward pressure. Prices fall faster. Margin calls force more liquidation. It becomes a death spiral. But a small group of players do the opposite. They buy. Or they've positioned themselves in advance to profit from the collapse. They have the capital, they have the nerve, and most importantly, they have knowledge. They understand that the government will intervene. The Federal Reserve will print money. Bailouts will come. The system is too important to fail. So they buy when there's blood in the streets. They accumulate positions when prices are at their lowest, when fear is at its peak. And they wait, because the recovery always comes, always. The Fed pumps in liquidity. The government spends trillions. Markets stabilize, asset prices recover, and those who bought at the bottom make fortunes. This has happened in every major crash since 1987, every single one. David Tepper understood this perfectly. His entire strategy was built on it. Buy distressed assets when everyone else is terrified. Bet on the government bailout. Profit when the recovery comes. He did it in the 1997 Asian financial crisis. He bought Korean stocks and Russian debt. Both crashed. He held on. Both recovered. He made a fortune. He did it again in 2008. Bought bank stocks and bonds at the bottom. Profited massively. His hedge fund averaged over 25% annual returns for decades. Carl Icahn built an empire on a related strategy, activist investing. Buy large stakes in struggling companies, force management changes, push for restructuring, extract value. Icahn compounded capital at 31% annually from 1968 to 2011. Over 40 years. How? By buying when others were scared, by using his influence as a major shareholder to force change, by being patient and ruthless. He made billions betting on distressed assets. He bought TWA when it was failing, restructured it, sold it for a profit. He bought Texaco, RJR Nabisco, countless others. Always the same playbook. Find value where others see only risk. Buy cheap, force change, profit. George Soros built his fortune on macroeconomic bets, understanding how currencies, interest rates, and government policies interact. He broke the Bank of England. He bet on the German mark after reunification. He profited from currency crises in Thailand, Malaysia, Indonesia during the Asian crisis. His quantum fund was one of the most successful hedge funds in history. How did he do it? By understanding that markets aren't efficient, that price doesn't always equal value. That emotional panic creates opportunities, and by having the capital and conviction to make enormous bets. Ray Dalio's Bridgewater Associates became the world's largest hedge fund by understanding economic cycles. Dalio studied debt, deleveraging, inflation, deflation. He built models predicting how economies would behave in different scenarios. He positioned his funds to profit regardless of what happened. If inflation came, he owned gold and commodities. If deflation came, he owned bonds. His all-weather portfolio strategy was designed to make money in any environment. It worked. Bridgewater delivered over $55 billion in gains to investors from 1975 through 2023. Notice the names repeating. Soros, Dalio, Tepper, Icahn, Paulson, Ackman, Spitznagel, Burry. These aren't new players every time. It's the same club, the same strategies, the same understanding of how the game works. They don't get lucky once. They win repeatedly, crisis after crisis. Why? Because they understand the system better than you do. They have capital you don't have. They have information you don't have. They have access to the Federal Reserve, to Treasury officials, to inside knowledge about what policies are coming. And they use it. Here's what most people don't understand. The system isn't designed to help you. It's designed to extract wealth from you. When markets rise, you're encouraged to buy. When they crash, you panic and sell at the bottom. You lose both ways. The billionaires do the opposite. They sell when you're buying at the top. They buy when you're selling at the bottom. It's wealth transfer from the many to the few. And every crisis accelerates it. After 2008, the wealth gap exploded. The top 1% captured almost all the gains from the recovery. Why? Because they owned assets that the Federal Reserve inflated with its money printing. Stocks, bonds, real estate. If you owned these in size, you got richer. If you didn't, you fell behind. The same thing happened after COVID. The rich got massively richer. Billionaires added trillions to their collective wealth in 2020 and 2021. While small businesses failed, while workers lost jobs, while inequality reached levels not seen since the 1920s. This isn't conspiracy theory. This is observable fact. Every financial crisis follows the same pattern. Asset prices crash. The government and Federal Reserve intervene with massive stimulus. Asset prices recover. Those who own assets get richer. Those who don't fall further behind. The game is rigged, not through some shadowy cabal meeting in secret, but through the incentive structures built into the financial system itself. Banks are too big to fail. Billionaire investors have the capital to buy when others can't. The Federal Reserve's mandate is to prevent market collapse, which means supporting asset prices. The system is designed to protect wealth, not to create it for ordinary people, to protect those who already have it. So what happens next? That's the question everyone should be asking. Because the same conditions exist today. Debt levels are higher than ever. Global debt exceeds $300 trillion. Government deficits are massive. Central banks have printed trillions. Asset prices are elevated. Price-to-earnings ratios on stocks are stretched. Real estate in many markets is expensive. Corporate debt is at record levels. The signs of fragility are everywhere. Interest rates have risen. The Federal Reserve is trying to bring down inflation, but higher rates mean more expensive debt service. More defaults are coming. The commercial real estate market is already cracking. Regional banks are struggling. Credit card debt and auto loan defaults are rising. When the next crisis comes, and it will come, what will happen? The same thing that always happens. Markets will crash. Most people will panic and sell. The government and Federal Reserve will intervene with massive stimulus. Bailouts will come. And the same group of billionaires and hedge funds will position themselves to profit. They'll buy distressed assets at fire sale prices. They'll bet on the government bailout. They'll make fortunes while everyone else loses. The pattern will repeat because the system hasn't changed. It's gotten worse. The moral hazard is greater. The concentration of wealth is more extreme. The expectation of bailouts is stronger. Michael Burry, the same guy who shorted the housing market in 2008, is warning about an AI bubble today. He's placed billion-dollar bets, shorting NVIDIA and other AI stocks. He might be early, he might be wrong, or he might be right and make another fortune. Carl Icahn, now nearly 90, is still making activist bets. Ray Dalio is warning about an impending debt crisis and currency devaluation. He's buying gold and Bitcoin. Paul Tudor Jones is positioning for inflation and monetary chaos. These guys aren't retiring. They're preparing for the next crash. Because they know it's coming. They always know. The lesson here isn't that you should try to copy them. You can't. You don't have billions in capital. You don't have access to credit default swaps and complex derivatives. You don't have relationships with central bankers. You're playing a different game. But you should understand what game they're playing, so you're not blindsided when the next crisis hits. Because it will hit. And when it does, watch who profits. Watch which names appear. Watch which firms make billions while everyone else struggles. It will be the same ones, the same strategies, the same wealth transfer. This is how the system works. Crashes aren't bugs. They're features. They're opportunities for those positioned correctly to extract enormous wealth from everyone else. The bubbles are created by easy money and speculation, the crashes are inevitable, and the bailouts ensure that those with capital win on both sides. This has been the pattern for nearly 40 years now. Since Black Monday in 1987 established that the Federal Reserve would always step in, it's not changing, it's getting more extreme. So if this video made you see things differently, hit that like button. Share it with someone who needs to understand how this game really works. Subscribe if you want more deep dives into the hidden mechanics of money and power, because these stories matter, not as entertainment, as education about the world you're living in, the world where a handful of billionaires profit from every crisis while millions suffer, where the system is designed to transfer wealth upward, where the rules are written by those with capital to protect those with capital. Understanding this won't make you rich, but it might keep you from being one of the people left holding the bag when the next crash comes, and it's coming. They're already positioning for it.